Thank you all for being here for this very important meeting today, a meeting we've been looking forward to with plenty of time for discussion. The first item this morning is adoption of the proposed agenda.
So moved.
Do you have questions or additions to the agenda? If not, a second?
Second.
All in favor say aye.
Aye.
All opposed say no.
Mr. Chairman, I abstained since I wasn't at that meeting.
Okay.
Well, this is just the agenda.
Yeah.
This is just the agenda, not the minutes.
Oh, okay, I'm sorry. I'll catch up.
But you have no problem with
Then
the
I vote
agenda?
yes.
Thank you. And then the next item is the February minutes, which have been posted. Are there questions or additions to the minutes?
I had one. I recall this. Didn't we talk some about the asset allocation and the reporting some at that meeting? I've gotten kind of the meetings confused with the meeting date changes. But I thought we had a little bit of discussion, because originally that was going to be the strategic planning meeting, correct? And I felt like we spent some time talking about the reporting and asset allocation. I don't really recall.
Focused on the.
We talked a lot about that stuff in the lead up to it.
Yeah.
And then in the meeting, the conversation around asset allocation, as I recall, was around the simplification, the Makita-led discussion on best practice, don't do it every year.
Yeah.
And then leading into
I didn't see that captured in these minutes is kind of my point. And I think that is a pretty important discussion that should be captured in these minutes. So personally, I'd like to see us get that some more added in and
From the Makita section.
like
I'll
around
have
the
to go back and
Makita
look at it.
section.
Okay.
Yeah. Because I thought they had some good stuff. I thought it was a good discussion and we didn't really capture it in the meeting. And we had a few board members who weren't here. So I think it's a disservice if we don't capture that. So personally, I'd like to see, another crack at these minutes if we could.
Okay.
I remember there was some discussion of the simplification of the portfolio, and then some questions at the end of that.
Yeah, I think we can.
Yeah, we can put some more. We can put some more meat on that.
Further discussion about the minutes.
You just want to carry them?
So I'll move that we carry them over.
Okay.
I'll second that.
Okay, all in favor of the minutes as carried over, say aye.
Aye.
All opposed, say no. That carries. The next item is the chair's report. I'm pleased to say my report will be brief. The vice chair, Rebecca, and I have met at least twice with the senior staff regarding the subject matter of this meeting. We and the staff have arranged the agenda so that much of it will be devoted to the discussion of strategic aspects of our portfolio. I will keep saying this repeatedly. We will have ample time for discussion, and I encourage all of us to participate actively in the discussion. In too many of our past meetings, we have run out of time just at the time to have a discussion. So I encourage it, especially for this meeting. The next item is the report from the Audit and Enterprise Risk Committee. Bill Hancock.
Thank you, Mr. Chair. And as we've done in the past, staff has given me a very concise. It's fairly detailed, but it's very summarized at the same time. I got this and I looked at it. I want you folks to look at the size of the font on this report. Now, I think that's because staff has seen how large this laptop is, and I get made fun of it all the time. This is not a sign of accomplishment or bravado. This is because I just can't see anymore. I think staff picked up on that and drew me something that I can actually read from. But our committee met on March the 5th, and we received from staff a compliance update. It was routine, and there weren't any material exceptions noted. We received some information on internal audit. We talked about the overview of the history of RSIC's audit function, previously completed engagements, and some of the things that were covered were the GIPS verification and the agreed-upon procedures, which the commission plans to do annually going forward, and the fiduciary audit, which occurs every 4 years. We talked about the results of some of those and then what to expect in those engagements coming up. The staff also explained to us that during the period when we had no in-house internal auditor, RSIC went through an exercise to ensure all major business functions had or were going to be in the immediate future reviewed by an external service provider. External service providers or other state agencies were successfully used during these external reviews, including the Division of the State Human Resources and the State Auditor's Office. Next, a plan for the commission's internal audit function was discussed, including outsourcing RSIC's internal audit function to an external audit vendor utilizing one of the vendors that the State Auditor's Office has pre-approved, which includes 3 in particular: Elliott Davis, Deloitte, and Experis. Next we talked about issuing an RFI for an outstanding internal audit vendor, which will conduct risk assessments and present a 3-year audit plan for approval by the committee. The vendor will then execute on a 3-year audit plan. There'll be more of that from our committee to come. The RFI should be awarded by June of this year, and work beginning in the July, and the 3-year audit plan ready for the committee to review in August. We have an August meeting. All right, then we received a presentation from RSIC's investments due diligence procedures as a part of an ongoing educational series about our processes and procedures, and that will be continued to be will continue to be presented to the committee. And finally, we've received an enterprise risk management update. The staff presented on the plan to implement Funston's ERM framework, which includes members of RSIC's leadership team having responsibility for ERM and the director of ERM and compliance facilitating the process. Any questions? That's all I have, Mr. Chair.
Thank you. Any questions for that report? Thank you. The next item is the report of our Chief Executive Officer, Mike.
Thank you, Mr. Chairman. You know, my report today is really just I get to have the pleasure of doing a recognition of a significant accomplishment among one of our staff members. At the staff level, we always knew that we were in the presence of royalty, but we also didn't necessarily know that we had a celebrity who was working on our staff, and that is Mr. David King, who was I think, as many of you know or have seen, he was recently recognized as one of the top 20 under 40. We'd probably put him somewhere maybe in the top 15. I don't know. The recognition really focused on his work with the Cola Biketown Collective. That is a wonderful organization that David has really helped start, and really to help get it to the point where it is today. They encourage the use of alternate transportation. They work with the city to establish bike paths. They've put in, I believe, at least 4 bike repair stations around the city, and I think that if I remember correctly, they've helped over 400 people get bikes as alternate forms of transportation. It truly is a great service that they're providing to the community, and I think it's just a shining example of not only really that we see demonstrated on a daily basis how hard our staff works on behalf of our beneficiaries, but also how hard our staff works when they're not here on behalf of their community. So, David, Your Majesty, thank you. And that's all I have, Mr. Chairman.
Any questions for Mike at this point? The next item then is the report of the Chief Investment Officer, Jeff.
Thank you, Mr. Chairman. David King is going to walk us through our performance in just a minute, but I want to just hit a few high notes for you. We had a great quarter. We don't have the final results through March, but we know that this is going to wind up being one of the best quarters we've had in the history of the organization. Exposure we added to the equity markets at the end of the year has been very productive for us. Not only that, but we've seen an improvement in our managers' performance versus passive implementation since the market bottomed. And David will walk us through that in more detail in just a minute. I wanted to share with the commission kind of big picture, how is our portfolio positioned today? We are modestly overweight equities in the amount roughly 2.5% to 3%. Within equities, the biggest overweight is to domestic equity, U.S. large cap. Smaller overweight to emerging market equity. And we are underweight developed non-U.S. Within our portfolio also, we are underweight fixed income broadly in support of that equity overweight. But also within core fixed income, we are as underweight as we are allowed to be right now. And the reason for that is the yield curve. Yields are low out in the belly of the curve. Front end yields are high relative to that historically. For the first time since the financial crisis, there really is not a penalty to being to holding cash right now versus core fixed income assets. Also, something that I want to note is that within our cash and short duration portfolios, and this has been the case for a good bit now, we are up in quality. We're staying away from triple Bs. The reason for that being we do not want to find ourselves liquidity constrained at the end of the cycle. So Mike Addy, who runs our internal portfolio, has been considerably higher in quality than we would ordinarily have to be. Bottom line for me right now, as I look at our portfolio and think about where we are in the cycle, equity markets got cheap for about 45 minutes in December, have rallied considerably and are now back to fair value, if not slightly overvalued territory. There is no meaningful term premium in the treasury market until you go out into long duration. Credit spreads are once again moving down toward the cyclical tights. And bottom line for us is we're back to being cautious. I don't see us extending our overweight to equities given valuation. And when I think kind of across cycles, one of the things that I think pays all investors to remember, and most notably people like us, late in the cycle is when you have to make sure that you remain disciplined and you maintain liquidity. So happy to answer any questions, go into any further detail, but I'm battling losing my voice, so I'm trying to be as efficient with my comments as I can, but happy to discuss any of those points. And if there are no questions, I'll pave the way for Mr. King to walk us through our performance through February. One thing I do want to note, a lot of the performance materials just emerged on Watchdocs, and it's because we just last week got those final details, and David and the reporting team moved heaven and earth to try to get the full reporting package ready for today. So thank you, David. Turn it over to you.
Thank you, Jeff. Good morning, everybody. Today I will be presenting our performance through February. We started off this calendar year with a sharp recovery from the sell-off that happened in December. The plan ended at February 28th at 199 basis points up versus the benchmark of 202 basis points. If we remember the last time we talked, the plan was sharply down, so we're up 640 46 basis points since December.
Can you go back to that? Sure. Got a question, and I'm kind of halfway reading the monthly flash report, but it has to do with comparing the total plan returns to the benchmark, policy benchmark returns. In most of the 3-year, 5-year, 10 years, since inception, the total plan is higher than the policy benchmark. More recently, it's flipped. What does that tell us? Are we not, historically, have we not taken enough risk? What's your thoughts on what that really means?
In the short term, there's more tracking error to our benchmark. If we remember, last time we spoke in December, private equity, that benchmark was the biggest detractor of our plan's excess return. As you'll see in a couple of slides, our private equity book hasn't really marked very much since December, but it's now one of a positively contributing slide. So that benchmark swung almost 700 basis points in 2 months' time. So some of that's those lagged benchmarks plus a spread. And in a short-term period, it's very hard to track to that.
But Bill, if you look at that Bonnier report, I mean, candidly, this was, and probably rightfully so, the treasurer complained that we had a very conservative policy benchmark because particularly around the financial crisis, the assumption was, right, that credit would rally and then typically you roll out your credit into your equity. But, you know, the Fed came in and printed so much money, right, that just, you know, we did have, our policy benchmark is way lower than the universe historically, and they've done a good job pushing it back up. So if you look at the more recent periods, our policy benchmark on that Boney universe chart is a lot more towards median now. But historically, that policy benchmark was way on the low end of things. And then the implementation is probably a little bit more aggressive around the asset classes.
So, yeah, I would add certainly to Alan's comments that I think are spot on. I mean, we, in this room, declared 3 years ago that one of the important things was to get the performance of the policy benchmark higher, because that would force us to get better. And that's candidly precisely what we've achieved that with rapid effect. And our portfolio is sort of catching up to that, is how I would high level summarize that.
Jeff, you said we decided to ultimately increase the policy benchmark?
Yeah, so I'll give you a couple examples. Well, I mean, we added a bunch of equity to the portfolio.
Yes,
and
absolutely.
That serves to raise the expected return.
Yeah.
Another thing we did was 3 years ago, we had a 5% target to cash, and that's inefficient for an asset owner like us to hold that. And that also had suppressed the performance of the benchmark. And then inside of some asset classes, and I'll take mixed credit as an example. There used to be 3 components to that benchmark, and it was high yield bank loans. Those are both non-investment grade. And then we had a third that was trying to serve as a benchmark for our structured credit. And what we had was I want to say it was the BarCap MBS index. Is that right? Which is a AAA benchmark. So we were, for a non-investment grade portfolio, we were using 2 benchmarks that were non-investment grade and then a AAA benchmark. So that was suppressing, I mean, small things like that we try to find and kind of root out in order to make the policy benchmark perform better.
Okay. Well,
3 years ago, as of December, at the last meeting, you would look, if you had stood 3 years ago, December 2015, I forget the exact number. I want to say 190 basis points. The policy benchmark trailed, the peer group, and that's benchmarked to actual returns, which is not a great comparison, but it's still, I think, informative as to where we were. It trailed on a rolling 3-year basis by 190 basis points, and I don't know. We'll get to it here, but radically different now. And it's part of, okay, we want to be better, so let's make it harder to,
But I also think
good.
the implementations are closer to benchmark than they were too.
oh,
I
yeah,
mean, the
yeah.
policy benchmark, I mean, the big takeaway, I think policy benchmark is more aggressive than it was historically, and the implementations are closer to policy than they were historically.
Okay, great.
And I think staff is truly to be commended in looking at, comparing our policy and our portfolio to the peer plans has pushed us to make decisions that have closed that gap. Not only is our policy benchmark closer to our peer policies, but our returns, that gap has narrowed significantly over the past 3 years through that decision-making process. So I think staff has done a really good job of narrowing that gap.
Yeah, but I think the one thing that we need to be clear on, and to make sure that we're all aware and understand, that comes by taking more risk, right? I mean, we're taking substantially more
Without
risk
question.
as a plan than we did previously, which is in service of a better return. So, that performance doesn't come risk-free, so.
So looking at our performance in dollar terms, we started the fiscal year at $31.3 billion. In that time, we've paid $805 million of net benefit payments, and we've had $584 million of investment performance, so ending at $31 billion. Looking at expanding that $805 million of net benefit payments, in that period, we've paid out $2.7 billion of requisitions. We've taken in $2.1 billion of deposits. In addition, we also had $376 million of payments associated with the unwind of the Terry program. And at the beginning of the year, we had a $100 million legislative inflow.
So we're still paying out more in benefit payments than we're collecting in contributions?
That's correct.
At what point in the, schedule from the pension reform, do we get to the point where we're not paying out more than we're taking in? Do we know?
We're not
That's
projecting
not
it at that point.
Yeah, that's
Yeah,
not
yeah, you don't ever
expected to
do that.
change. As a mature plan, we are
Never.
going to pay out more. If you don't take into consideration investment returns, we're going to pay out more in benefits than we collect in contributions. So that's
So
part
even
of
as
the-
contribution, even as the employer contribution rate rises over time, we will still never.
The gap will narrow, but it won't
It
go
won't completely close.
inverted. It won't.
Because the-
And as a percent of plan, like what is that number? Is it 3%? It was
So,
up around 4.2.
It had gotten, it had gotten up to around 4, right now. This year, if you think about the without the Terry noise, I think it would be close to 800. Does that sound right to you, Peggy? But that should continue to move modestly lower. But 800 on
We have about,
3 is about 2.6%.
yeah, and we've
Or
got,
800 on 30 billion is about 2.6%.
with the
James,
full,
do you know how low that, we're projecting that to go as a function of value?
Yeah, 1.25% to 1.5% over the next 5 years.
yeah, it's about 300 to 400 million, right, negative, because we've got another, how much, like another,
We'll have, currently the employer rate's at 14.56.
Right, we've got
It'll go up to
4%.
15.56 July 1, and will ultimately go up to 18. So we'll increase the employer contribution rate by 4% more than it is today. But the ratio of active employees to retirees continues to diminish. Right now, we have about 140,000 retirees and only about 200,000 active employees. If you look 10 years ago, we're more on a ratio of 3 to 1, and that gap is narrowing as baby boomers get older and retire. So that is also one of the complexities of a mature plan.
Would you say, is that a variable to which the net cash flow is really ultra sensitive?
I think that's.
We can catch up.
Yeah,
offline.
I know the actuary provides you with the projected cash flow, so he's taking that ratio into consideration when he gives you the projected cash flow.
But still, getting that gap from a cash flow down to what yields on the blended portfolio actually look like means you're in a much more sustainable position. I mean, when you're at 4.2 in cash rates or where they are and dividend yields or where they are, if you turn on your cash flow, you still got a gap at 2.6.
Liquidity matters.
You can solve for that, right? So that's that's a big improvement from a cash flow modeling standpoint.
So at one point, we were roughly, I'm thinking maybe 3-4 years back, we were roughly from strictly cash in, cash out, was about $1 billion negative. So where are we projected to be after the full effect of the last legislative action? Negative $4 million a year, 400 million, negative 300?
About 300 to 400 million.
300 to 400?
Yeah, somewhere in there.
That's a very sustainable number.
Well,
Right? I mean, even at 800, you got enough to weather,
I get it.
right?
I just want to know where we were supposed to be when this
Well,
was
that's
over.
also, kind of classically, you think classical finance, that's what enables us to take more risk
Correct.
in the plan. Having that, not be kind of the albatross around the neck of the plan. It allows you, because you can still provide liquidity sufficient to run the plan without,
Selling
having to worry
assets.
about kind of day-to-day risk.
Well, one of the, when we presented last February to the joint committee, when they were talking about the kind of the cost and the impact of moving, from a DB to a DC, one of the things that we showed was the positive impact when you think about kind of the range of probable outcomes of the plan, of just how beneficial those cash flows are to the plan, because, and we can, I think those charts give a very good picture, visualization of how kind of the invisible hand that we have now, those cash flows holding up the plan. We can send those out to y'all, and, because I think it's a very kind of stark, indication of just how significant those contributions are to the ultimate success of the plan.
Peggy, at the completion of the Terry payments, how much of that will be covered by legislative inflow?
Well, the remaining Terry payments are just people who haven't received their money yet. All the Terry was considered payable June 30th when the plan closed. But some people still haven't rolled their money over, so it's trickling out. So there's no more, there are no more Terry participants eligible for any more benefits than what's in their account right now. They just haven't withdrawn it yet or rolled it over. So we're still working through some of those lingering accounts. I don't think there's very much left after this last group of payments.
But the total of the Terry payments, was that completely covered by legislative inflows, or a substantial amount of that came out of the fund, right?
So from a cash flow standpoint, that's very different from the accrual of benefits. Over the length of the Terry participation, then the account, from an accounting standpoint, that money was segregated. But from a cash flow and investment standpoint, it was not paid out until the end of Terry. So you had a huge amount of money. I think over the 1 year, it was about $850 to $900 million paid out over that last year. It was never designed for those payments out of the plan to coincide with legislation. They weren't connected in any way.
So the answer is none.
Would it be, do you think it would be, Mr. Chairman, do you think it would be beneficial to, I don't know if this is something that you'd be open to, having kind of a actuarial boot camp at some point?
I'd love that. I didn't mean to jump in, but I mean, just go back to our original picture. We have a 10-year return of 9.5%, which is well over our assumed rate of return to make the plan, I guess, work. And yet we've still seen, increase in unfunded liability for a variety of reasons. I understand most of them are actuarial, which I find difficult to comprehend. So yes, that would be helpful. There was just a article in the Wall Street Journal yesterday that said despite a long bull run, we still have all of these state and local pension plans that are still racking up higher unfunded liabilities. And so I think getting a better handle on how we look at this and estimate this over time, because I do worry that this, I would like the plan to be sustainable for, infinity. And not understanding how we build the models or not being able to accurately identify how much we're going to have going forward is I guess, is worrisome.
Okay, I mean, I don't see us as presenting that, by the way.
No.
I was trying to.
We can certainly have the actuary, available. We can, coordinate some dates on that. One thing to keep in mind, and I think it has, been visible in some of our other discussions as well. When you look at the return and what base that return is based on can have a huge impact. So when the plan lost so much money in 2008, 2009, it takes a much higher rate of return to get the plan back to. So in thinking
Clearly.
of a 9% rate of return, that's not a 9% rate of return on a consistent base of investable assets.
Yeah, and that's a really good point also, because it goes back to, I think Nikita presented a stochastic set of returns where we had high gains in the beginning of a 30-year period and losses in the end, and then they ran it the opposite way. And based on those the returns and I guess the scheduled returns over time, we may not reach our full funding at the end of the period. Yet from an actuarial standpoint, we only make 7.5% or 7.25% rate of return, this very deterministic model over time. So.
But that's where the cash flow matching is critical, right? Because if you got the cash flow, you can let the assets bounce up and down.
Yes.
And you're not going to run into an issue.
Yes.
It's when you have to sell assets.
That's exactly right.
Right, so, I mean, getting it down to 2.6 is in my mind, a very sustainable number. I didn't feel like up at 4.2 is where it was a few years ago, 4.3, I think, 4.4, something like that. I mean, it was way up there. I mean, 2.6 is a very, in my mind, sustainable cash flow situation for the first time in the plan's life.
And another key part of the 2017 legislation was an expectation that investment performance would be lower than expected for a significant amount of time on the front end. So they set the contribution rate sufficient to withstand, only a 4% return for a 5-year period. Now, that could be 10% negative in 1 year, but they were looking at taking into consideration not getting a 7.25% rate of return every single year, understanding that, as rates are volatile, it does make a difference in when that return hits the portfolio.
And I do think that they're beginning to weave in some more stochastic models into how they're approaching it, which only accrues to the benefit of.
The actuarial period, the assumption now is what, 20 years?
In the state system, the amortization period is down to 22 years, and in the
22.
police system, it's down to 20 years.
I'm sorry, say it again, the difference.
The police officer system is down to 20 years,
Yeah.
and the state system is down to 22 years.
That's about an 8-year shift too. So, I mean, it's a much better plan design now.
And part of that is attributable specifically to the component I just mentioned. We haven't hit any of those adverse experiences that they anticipated. So not only have we not hit those, but we've exceeded the 7.25% rate of return. So that has acted as a significant, to move the plan significantly further along that progression than expected. But whenever we do hit those adverse returns, whether that winds up being the end of this fiscal year, or we know that at some point in time we will face them, and the design is built in to expect that when those occur, the contributions are sufficient to withstand that volatility.
Yes, I think these are very important discussions, and just based on the cycle of meetings, we are due to have an asset liability focused meeting soon, and it would be good, following up on what Rebecca said, it would be good if we have the actuaries. At the time that meeting is held, it would be very good to have the actuaries there to add to the discussion and to answer questions.
Mr. King is probably about to pass out.
So looking at our portfolio exposures, at the end of February, you can see that we are overweight public equity. And as Jeff mentioned before, you see it, we're as underweight as possible for core fixed income with a strong overweight to cash.
Go ahead, Bill.
At the risk of wearing your voice out even more, Jeff,
Yes, sir.
we talked about previously cash being a drag on the portfolio.
Yes.
And here we are with it at the top end of
Yep.
the compliance band. Can you speak to that? Why we got
Sure.
so much dry powder?
It relates to the inversion of the treasury curve. Right now, you get paid more to hold a 3-month treasury, which for us is classified as cash and short duration, as you do to hold a 7-year treasury bond. So we just, in recognition of the challenges with the treasury curve, we have made the simplifying decision to, since we don't sacrifice return right now, to hold that treasury piece in cash, maximizes our flexibility to react to markets. But also, let me follow that question with what would cause that to be wrong would be a further decline in rates. And rates have, I believe the 10-year has fallen 80, 90 basis points over the course of the last year. And at some point, I think we'd say, okay, that we've gotten all of the benefit from that decline in rates. How do we move out of the way in case there's a normalization that pushes that back part way? So we're not, in our view, sacrificing anything right now, because today, the cash rate is effectively the same rate as that kind of belly of that curve. Whereas 3 years ago, you were looking at a cash rate, Alan, I'm going to need you to help me out here.
0.
10 bips.
Yeah. I was gonna say 25.
I'll say 25.
And a treasury curve that might get you 3. So you were foregoing something back then that you're not foregoing now.
So in my simple accountant's mind, we're getting as good or better returns with a lot less risk.
Correct. Yeah, let's just do this.
Okay, all right. Thank you.
One thing I was thinking on that, I like that chart a lot, but I know we talked about it in risk space. If there's a way to add that chart, kind of risk weighted,
Yeah.
be a good addition, just for what it's worth.
So looking at our market value, you can see plan assets have recovered $1.8 billion since we last spoke in December, where we were at 29.3. We're now sitting right at $31.1 billion. Looking at our peer rankings on a fiscal year-to-date 1 and 3-year basis, for a rolling fiscal year-to-date peer rankings, we're at the 48th percentile. Our rolling 1 year is at the 74th percentile. Our rolling 3 years is at the 82nd percentile.
And this is great, that we're above the median in this last period.
Moving on to our asset class performance, you can see that markets have come back sharply. Our highest performing asset class on an absolute basis is other opportunistic, followed by private infrastructure and public real estate. Our negative performing asset classes right now are public equity at negative 35 bips and our portable alpha hedge funds at negative 92 basis points. Looking at relative returns, other opportunistic is outperforming the benchmark by 689 basis points. Private infrastructure is outperforming the benchmark by 227 basis points. On the other end of the spectrum, portable alpha hedge funds and mixed credit are underperforming by 258 and 104 basis points respectively.
So David, when you talk about our underperformance on the public equity, do we have any idea of whether that's underperformance more on the domestic equity or the international equity? Since we've kind of lumped it all together, we don't really see, have transparency into seeing that breakdown. Do you have any information on where
Both.
that, both? Okay. And is it equal
Tough
both?
environment for active management recently. And I would extend that back 3 years even. It's been a difficult ecosystem for our managers.
Not just your managers, active managers in general.
Thank you, Frank.
So looking at absolute return on the x-axis and excess return on the y-axis, you can see other opportunistic is leading the pack on both absolute and relative. I'd like to mention private equity because the returns only changed by 8 basis points, but that benchmark has, in the last 2 months, the benchmark had a negative 650 basis point return. So even though the absolute return didn't change, the relative return changed significantly.
David, would you remind us what's included in the other opportunistic category?
That is our reinsurance, as well as there's a strategic opportunities fund as well, which was hedge fund best ideas.
David, can you go back 2 slides?
Sure.
Yeah, I think somebody just asked, or mentioned it, something I wanted to ask. These asset categories, asset class categories or subcategories that were on this page, and this pretty much matches the monthly flash report too. They don't match up 1-to-1 to the asset classes and the subclasses that we approved a year ago, February. So for instance, equity options, and what we approved there was a subclass of global public equity. Other subclasses, as somebody, I think it was Peggy just said, developed U.S. and developed non-U.S. were subcategories. So we've got some subcategories, not others. I'm just wondering why we have a mix here, and we're not, because I mean, I'd like to, I think I'd like to see
Bill, can I
comparison to
jump in?
what we approved, including the subcategories.
I hear you. There would be an alarming amount of complexity to show you long-term returns for strategies. So we don't hire a manager necessarily to invest only in the U.S. or only in developed non-U.S. and only in EM. We have some strategies that invest across these. So it would be very difficult for David to stand here and break down performance, breaking apart, one fund into the return that came from emerging markets, the return that came from developed non-U.S., and the return component that came from U.S.
Okay.
That's the simplest challenge to this. Even if we did it, let's say last year we restruck all of our mandates, then the challenge would be we couldn't show you the detail going back very far because we would have had to cancel those old, mandates in order to do it. This is part of, you were kind enough to share this question with us, so I've had time to think about this.
Yeah.
I hear you. And I will say that as it relates to equity options, we did come back after the February meeting and we set that up very, very much separately as an asset class, with its own not only target, but range and benchmark. So that one now functions very much like a separate and independent asset class from global public equity. So I hear you. There's not a tremendously satisfying answer that we can give you. This is the way that we can produce, longer-term performance, so you can see over time how things are going. We can certainly, in the framework we're going to discuss, I think there are ways that we can drill into this more creatively. But I don't know if, David, you want to add anything to that?
The only other thing I add is we do track the exposures across those sub-asset classes for public equity. And that is in the flash report that we send out. So I can spend some time with you and walk you through how those numbers flow together and how that works. And that's an open offer to any of you.
So if you track exposures, does that not mean that you do go into those mixture of funds and break things out?
We look at the benchmarks of those funds, so the strategy benchmarks. So if a manager tracked across 3 or 4 different asset classes, we can look at the benchmark or the mandate they were given, and we can take that and spread that out into each of those buckets. So it's our best approximation of how of their mandate, how that's diversified. And we look at it that way so we don't undo any alpha decisions when we rebalance the portfolio.
So we don't, I was thinking that we approve target ranges for, say, developed non-US equity.
We did not do ranges for that.
We didn't do ranges for subclasses?
There's a target, and the target is used to create excuse me, the benchmark for global public equity. We did not approve ranges for the subcomponents of global public equity. And to your point, you saw equity options look different. That's because we came back later on and gave that not only a target, but a range around that target. And that is excluded from the benchmark calculation for global public equity. So it's very much set up differently. But for U.S. equity, that is a component of the global public equity benchmark. It does not have a range around it. Global public equity is where that range exists.
Okay.
I don't know if I'm contributing.
Well, I'd probably have to look back at some source material to kind of really understand it. But I mean, TIPS is another example up there.
Yep.
At the same time, we added TIPS and we added treasuries or a specific subcategory to both. I see TIPS, not treasuries necessarily. So I don't know. There's just, on some other reports, we break out real estate in infrastructure, but then we don't break it out into public and private, but then we don't break out the private into core and non-core. It just seems inconsistent, and I'm not sure why we do what we do in many cases.
Yes, and the last 3 minutes of us talking is, I would like to submit that as Exhibit A commercial for simplifying our policy asset allocation.
And I missed that discussion last time, but I'll just throw. But then how do we know whether our allocation to TIPS was successful? Because it gets lost in the shuffle.
If I could have.
Possibly, and that might not be a good
We will
example.
get to that in the discussion of that framework.
Thank you. Sorry to take up everybody's time.
It's a appropriate question, and it's just one that doesn't have a simple answer.
Yeah, okay.
I apologize.
No need to apologize.
So looking at our attribution or each asset class's contribution to the plan's excess return, you can see a couple of interesting things here. There's a pretty large allocation effect in the portfolio at this point in time. Those are largely due to the trades we put on at the end of the year. You can see core fixed income and equity options are the highest contributor to the plan excess return. On the other end of the spectrum, you can see global public equity and cash being detractors. And I like to think of the cash and core fixed income as a paired trade. and just looking at this visually, you can see in the gray bars the allocation effects. In the blue bars, you can see the selection effects. I went back and just did back of the napkin numbers for all of those trades we did at the end of the year combined. There's about 20 basis points positive allocation effect. And that's taking the overweight to equity, selling core fixed income to support that, and then mixed credit and the overweight to cash.
Excuse me.
At that point, I would like to pause, ask any questions.
Thank you, Mr. King.
Thank you.
Thank you, David.
Can I get the clicker from you? Thank you. Boy. All right, Mr. Chairman, at the last meeting, we walked through a mid-year update of our progress toward AIP initiatives. This quarter, I wanted to update you on a few areas where we've continued to make progress. I pledge I will keep my comments short because I'm starting to feel the effects of drinking a lot of water to keep my voice. So we have continued to make progress, and for reference, Mr. Condon, you were not able to be here at the last meeting. We've broken out our initiatives into those where we expect to achieve completion during the current year, and we've separated out those that are multi-year initiatives. And our taxonomy here is we separate those and then break them down according to whether they're completed, nearing completion, ongoing, or too early to determine that meaningful progress has taken place. And those areas where we have pushed the ball down the field here include our co-investment program. We are very pleased to note that we have concluded negotiations and closed on our co-investment platform, and we've done this with Grosvenor. It was a 2-year project with a tremendous amount of work done by our team, our private equity team, as well as James Wingo. We're excited to begin this partnership and look forward to updating you as it gets up and running and we start seeing activity. Another item that was very important to us was identifying a strategy to exploit credit market turbulence when it arises. This is an area where we've done a tremendous amount of work. We're very excited about opportunities that we have found and are finalizing negotiations relating to one such opportunity as we speak. We'll be very thrilled to provide that update at the next meeting. We have continued to shine a light on the question of whether to employ active or passive management across our portfolio. Brian and his team have developed a scorecarding system that we have begun to use at the internal investment committee level. I promise more to come on that. We have also evaluated whether or not we'd like to add an additional alt beta strategy. Brian will address this later on to you. In short, we are not prioritizing that. And then finally on this page, private debt and mixed credit, we are, the item here was to put ourselves in a position that we can track kind of fundamental differences between the two in order to help us determine whether we want to express a preference for private debt or for our listed credit portfolio. made progress here in two ways. First, we're more effectively leveraging resources provided to us by our partners. And then secondly, we have subscribed to some broad credit research that has been very useful to us and we're already drawing benefit from. I'm not calling this a completed initiative, but we are definitely moving the ball downfield. Then multi-year initiatives, our non-portable alpha hedge fund portfolio. We have done what we can do. We are simply waiting for liquidity to materialize, and that's why this is categorized as as nearing completion. Otherwise, I don't have anything meaningful to report. The non-investment team initiatives, again, we're working on. We don't have detailed progress to report there. But let me pause and see if there are any questions.
Can you refresh me on what that non-portable alpha hedge fund wind down, what the wind down, are we
So-
trying to get out of hedge funds?
We are trying to
Or just get rid of
hold
some of
hedge
them, or
funds
what?
in one part of our portfolio, and that is the Portable Alpha
Just
program.
portable alpha only?
We had legacy hedge funds where we used hedge funds inside of asset classes, so equity, credit.
Yes.
That is not something that I want us to do. I want the flavors of hedge funds in our portfolio to be low beta, not bringing systematic risk into the portfolio, but bring idiosyncratic risk associated with alpha trades. So this is a wind down that is 2 years in the making, ever since we kind of began to root out those strategies. And it's not to say that these aren't right for other people. They're just not, they don't fit with our vision for what we're trying to do. So is that responsive to the
Yes.
question?
Just one follow-up. So is that initiative to develop a plan to wind down or to actually literally wind down?
I'm sorry, I coughed in the middle of what you were saying. I apologize.
This multi-year initiative, is that to develop a plan to wind down?
No, that is
or to actually wind down?
To be done.
Okay.
And we are
Excellent.
very close to completed with that.
Okay, thank you.
If there are no further questions, I will move on briefly to our delegated investment report, which, as you can see, will be very brief. We made one investment. We closed one investment between the last meeting and this meeting. It was a private equity investment with Providence in their strategic growth series. We're a current investor in a prior fund, so this was a re-up. Fund targets growth companies in the lower middle market, which is an area where we have not had a great deal of exposure. They focus on software and technology-enabled services businesses in North America. It's a buy and build strategy. They build broader platforms that are attractive to larger technology-focused private equity funds. Their sweet spot is to hold approximately 20 deals in the portfolio with equity investments ranging between $5 and $75 million apiece. From the private equity portfolio perspective, we are overweight large and mega cap funds and underweight to strategies such as this. So this is an investment in service of that broader portfolio goal. Happy to answer any questions. We have provided summary to you all pursuant to our closing process, but happy to answer any additional questions that you may have.
And just to point out the obvious, we are past the closing date, so we've had the opportunity to review at that point, before that point.
Yes, thank you, Mr. Chairman. So, yes, sir.
This is not specific to this deal or ones that are in the pipeline now. Outside reading, I'm doing it, there seems to be, there's a clash. And the side that I think we want to be on, this 2 and 20, gotta go away. So how do we do that?
Let me,
You don't have to.
walk you through a cascade here, but
We can go through that
we
later.
are doing.
Okay.
So if you think, let me talk 2 and 20, not at the individual fund level.
Right.
But let's talk more broadly at the private equity portfolio level, or, which includes all sorts of investments. The easiest way for us to reduce our cost and at the same time improve our returns, we are doing. And that is, we are taking additional investments, and Providence Strategic Growth, let's use them as an example. We invest $75 million in the fund at that 2 and 20, and then we encourage them to show us co-investment. So we can make additional investment in those same exact companies that through the fund, we have to pay 2 and 20. So that is the simplest way to not only take down return, but have that reduction, or take down risk or cost, but have that reduction in cost translate directly into improved returns. So that's the low-hanging fruit. Right now, we can, and we are looking at secondary opportunities. If you acquire a secondary fund, you may step into a situation where you are paying 2 and 20, but you did not pay 100 cents on the dollar for that opportunity. You can, one thing I can tell you is negotiation is very challenging right now because the world in a low return environment flocks to things that it believes are higher return. So you think of laws of supply and demand, that is not on our side right now. But those are 3 kind of high-level strategies to try to take costs down.
What was on my mind wasn't so much, that's the world we live in, is how do we find our way to the co-investment platform quicker? That's a question. I'm not looking for an answer from you specifically. I'm just saying, why can't we get there quicker is what I'm asking out loud.
Yeah. Well, I think with establishing the co-investment platform, I think we have now hung out the sign that we're open for business,
Well,
which to actually have like a real process by which we can say yes or no quickly.
And that's what's prompting my thinking, Mike. Is you all showed me that there's a way, so you're letting me sit in the car. We're not going very fast yet. Right?
Well, and I'll call back to the presentation that James gave. You not only need the platform, but you need the process.
I know. I'm impatient.
Sure. We are patient, but we are motivated. Okay. And I think you will see, we are just, and this is the testament to the work that my team has done on this. We are seeing a tremendous amount of co-investment opportunity now because we have the platform and we have, more importantly, I think, we have a process where we can leverage the work that we have done, deep work, to get to know the general partners that run these funds so that when they show us an opportunity, we're able to get them an answer and stand behind that answer and deliver capital at the appropriate time.
Jeff, thank you for your response. Mike, you too. I didn't mean to hijack the whole conversation.
It's worthwhile.
Yeah, no, we're excited about it because this is going to be a very meaningful driver of improved return for us.
Yep.
I mean, this is like Jeff said, I mean, this is the one area where you pay less in fees that translates like immediately into return. So that's the whole point of paying less fees. It's not just to pay less fees, it's just more,
Just
right?
to be clear, you guys are the ones that got me excited about it, okay?
We did a good job.
It's our fault. Yeah, we did.
And let me just add that I commend staff for thinking about these issues and trying to reduce the fees while yet getting good investments and finding other alternatives. But I still, and I know Jeff, you and I have talked about it before, I still want to get a grip on where our PE portfolio is today You know, there's probably a lot of old legacy stuff out there, and then what I'm unclear about, because there seems to be several strategies, good strategies we have with respect to PE, this Grosvenor co-investment deal, doing co-investments through existing funds, that's a little bit different, and maybe some others. Do we have so I'm a little, what are the strategies is there one strategy? Are there numerous strategies? Or do we have a goal that 50% of our future PE investments will be, or maybe total investments in PE will be through this Grosvenor model? You know, I'm not, we've got numerous strategies, and I'm not sure if it's one, if it's multiple, and what the goal, where we're headed for each. So when we get one investment, I find it a little bit difficult to put that into the overall scheme, because I think our overall scheme, and I commend you all for doing it, the overall scheme needs to improve. I'm just not sure where each individual piece fits in the overall scheme most of the time.
And that's
And
good
that's
feedback.
part of that's me, but I need some help.
That's good feedback for us, and what we can do is we can work on how do we kind of map it out for you, like, you know, without having it feel like astrology. We can map it out in a more concrete way for you.
Okay, thank you.
And we'll do that. And we'll provide that to everyone. If there are no further questions, I will yield back to you, Mr. Chairman.
Thank you very much. We're about to move into executive session, and I strongly recommend we take a break just as soon as we
Thank you.
move into executive session. So, is there, may I have a motion to move into executive session?
So moved.
Second.
And a second. Any discussion?
What is
All in favor, say aye.
the reason why, legal counsel?
It would be
Yeah,
good if we
beneficial.
state the reason why we're going
Yeah.
into executive session.
I can read it if you want to, Mr. Chairman, if you want me to. The
Thank
motion would be to proceed into executive session, discuss investment matters pursuant to SC Code Section 9-16-80 and 9-16-320, and receive advice from legal counsel pursuant to SC Code Section 30-4-70, subsection A2.
Thank you very much.
Thank you.
Thank you.
From our returns. Furthermore, and this is a criticism of the way we have always approached it, we've only ever encouraged you to focus on very short periods of time. This meeting, we talked about an 8-month return. Last time, we talked about 6 months, and so on. I'd like us to zoom out and look at whether our investment strategy is working over longer periods of time. And I'm going to come back to this in a few minutes. What we are proposing in this total portfolio framework is the creation of 2 additional benchmarks. The first is called the reference portfolio. This is a simple 2-asset stock bond portfolio. The nuance here is that the reference portfolio and the policy benchmark are designed to have the same level of volatility. The notion here is it would only make sense to adopt a more complex portfolio as the policy benchmark if it gave you either better returns or less risk. And if we hold the risk of those 2 portfolios constant to the same level, what is revealed is what we refer to down below as the value achieved from diversification. And this is expressed in the differential returns between A and B. The second new benchmark is we're calling the implementation benchmark. It's designed to include any decision that we, the staff, make to structure the portfolio differently than the policy portfolio. And there are 2 main levers for this to occur. One is we make an asset allocation decision, and I'm defining that as as overweight one asset class bucket and underweight another asset class bucket. The other way is we can construct an asset class differently than the benchmark. So by comparing this portfolio, it shows the portfolio we are attempting to have. By comparing that portfolio to the policy portfolio, you can very easily isolate both the risk and performance implications of any decision that we have made that causes those two to deviate. And that's something that we have not had before. The other significant benefit of having an implementation benchmark is that we can now isolate the impact of how we structure the portfolio from the impact of who we hire to manage the portfolio. And how we structure the portfolio, that the quality of that is picked up in box F, the quality of portfolio structure, and the value add from the managers that we hire is encompassed in box G, the quality of implementation. So I'm not going to hit on everything on this page, but I thought it would be helpful to highlight some common examples of decisions that would be reflected in both the risk and return of the implementation benchmark. As I alluded to before, I'm defining asset allocation decisions as those that overweight or underweight an entire asset class. In December, for example, we added public equity exposure and made corresponding reductions to our fixed income portfolios. That is an asset allocation decision. I have 3 examples in the middle section here of asset class composition decisions, and I'll just pick one of them. In the case of our mixed credit portfolio, our policy benchmark is comprised of 50-50 mix of high yield and bank loans. If we decide that we want to shift to bank loans with 85% of our portfolio, this is a decision that very much can affect the risk characteristics of the portfolio as well as its performance. So creating a benchmark that captures these characteristics as they change will help me, and by extension will help you, assess the quality of our decision making. I would argue that this is particularly useful not only to me but to you, since these are decisions that we don't have ordinarily, historically, we haven't had a pattern of discussing in commission meetings. And I think through this framework, we can make this very easy for you to see these changes. Our thought is, and Mike and I both share this thought, is that in commission meetings, we would highlight the ways that the portfolio looks different in practice than the policy portfolio. Have these deviations added risk? Have they added return? We'd have that conversation in the commission meeting.
And in some cases, what you refer to as benchmark is a measure of opportunity cost.
Yes. So the opportunity cost portfolio, I would argue, is portfolio A. The simple, frankly, almost costless portfolio that could be passively implemented would be portfolio A, and it would be a mix of global equities and treasuries, as an example. So this is something that Mike alluded to, and he and I both believe very strongly in this slide, because we both believe each decision should have a clear owner and an appropriate time over which the decisions made will be evaluated. And we both believe that this should, marry to the extent we can with the broader goals of the system. And we think it's good governance to clarify not only who owns the decision, but clarify the role that the commission sees that it serves in in these decisions. What do I mean by that? You can see on the left, the establishment of the policy benchmark contributes to the value from diversification. And down below, you see the commission role is to set that portfolio, sets the policy portfolio. Over on the right, as you move, now we're talking about day-to-day decisions, and that's really not where the commission has chosen to focus. So those fall to me and to my staff. What is the commission's role, though, where it has ceded day-to-day authority, is to create the right policy ecosystem for those decisions that it encourages the staff to make, and then make sure that you have the right oversight. And this speaks to the quality of reporting that we provide to you. So this is oddly a very important slide to us. Let me keep moving quickly before I completely lose my voice. So what do we think changes here? And I don't want to be redundant and keep saying the same thing over and over. Actually, I do want to, but I'm suppressing that. And
You just did.
And you're very welcome. So I'll just hit the high points here. We're building this to give me better oversight of the portfolio. I think it makes sense for you to benefit from this perspective as well. We would like for this to become an important part of our meetings, kind of the centerpiece of how we talk about the portfolio. Our thought is that this would replace the current performance framework that David King does a great job with. If you agree, we would try to bring this to fruition by the September meeting. We would like to use the next few meetings, frankly, to continue to develop aspects of this framework in collaboration with the commission. And it's important. It's a simple framework. There is a lot of work under the hood to bring this to life. And we have a great team that I have every confidence in their ability to support this initiative. But we want to make sure that we're having, first and foremost, we're having a conversation here about this and about what this can do. And I certainly want to hear your thoughts on it.
My reaction, I mean, we went through this the other day, but it just kind of caught my eye, because I think this is a good example of the difference of a higher level decision and a lower level decision. For example, is Portable Alpha policy decision implementation. To a degree, that is implementation, but it introduces operational related risk items that I think should float through the Risk and Audit Committee, right? Because meaning that expression of that implementation introduces new operational risks that you structurally need to be able to handle and report on and be aware of, right? So in my mind, that's I think a very good example where, all right, it does have implementation things, but there is definitely a board function to be played on that.
So can I contribute to that? At the last meeting, when we had the conversation about simplifying the portfolio, it was very important to me, regardless of where where do we classify the Portable Alpha decision? Is it in the policy or is it an available tool over here? Still, the commission needs to make sure that the use of it is constrained. For obvious reasons. So we're not asking to move away from, the constraints on it today. But the question is it in the policy benchmark? Is it in the implementation benchmark? Excuse me. So, but I hear you, I agree, because there are very important characteristics about Portable Alpha that need to be understood, need to be you can't be silent on Portable Alpha and then have us out there with a 20% Portable Alpha program. That's illogical and I don't think prudent. So.
Jeff, a question, and I think we talked about this earlier. A lot of this revolves around these benchmarks, but real question is, how do we set the benchmarks and are they entirely accurate? In the past, we've had some discussions as to how accurate the benchmarks really are and how they should be set.
Yep. Fair question. I think, and I've asked Frank and Aaron to brace themselves for a much broader discussion if we want to go down this path, and also, you know, candidly, I want this research done regardless, because I'm not satisfied with a couple of our benchmarks. I think we can do better. But think of, let me describe how the implementation benchmark comes into existence. It is, the commission is not asked to make a decision about how to set that. That takes into account every strategy we actually have and what is the benchmark that that manager is competing against. So if we hire a bunch of value managers, right, then what would happen is the implementation benchmark would take you to the level where you would, from that point forward, be cleanly able to assess, did the manager outperform that benchmark? So that exists at the individual strategy level. All we're doing is rolling up all of those. So you would basically see in that benchmark, how have we positioned the portfolio? So if, the other examples that
The formula you had there was how to roll it up.
yeah, and I can thank James Wingo for that. So that's the kind of mathematical nomenclature for how we see it. It's the actual weight of every strategy times that strategy's benchmark. So you're adding up 100% of the portfolio according to what have we hired people to do.
Again, the hard part of that is selecting what that strategy's benchmark is.
Well, the good news is we have that in our IMAs, our investment management agreements. You know, there may be a handful of places where we have to make a judgment call. I think private markets will be challenging for this. What level of granularity do we go down to? I'm in favor of keeping that.
Basically, we'll be using the strategy that was identified in the organic document.
Yeah, and if you go back to when did we recommend a manager? You know, if we stood at the podium up there and we said, we want to hire, and I'll choose a random Pyramis Asset Management to run a small cap portfolio for us. Benchmark that we gave them in the investment management agreement was the Russell 2000. We would take their weight, and if they're 1% of the portfolio, their contribution to that rolled up benchmark would be 1% times the return for the Russell 2000.
As you know, I like this whole concept a lot, but to what extent is that our creation as opposed to you ran across it in academic literature or other people are doing it? What's the genesis?
So let me back up. This, I think that comes from the Canadian CPPIB, and I think they've done a great job with it. I've been very impressed with the work they've done on that. Policy benchmark is the policy benchmark. The implementation benchmark is actually what I want to have is two sub benchmarks, one for asset allocation decisions and then one for portfolio composition decisions. If we jump to the combination of both of them, that's what this is. So this is basically just trying to map it to decisions. So I can't tell you frankly where that came from because it's something I've wanted for so long. I don't recall where I first saw it. But one other important thing is policy will be what the commission sets. Actual will be actual. I mean, there's no, we can't make that up. So I'm trying to find the useful point for the commission to separate the decisions largely made and effectuated here from the decisions that we pay external managers to implement. So that's the kind of why draw the line there, is to try to kind of create a distinction between our intellectual property and the results from that from what we hire the managers and pay them to deliver.
And I like that part of the proposal. I like separating what the commission's responsibility is and with staff and giving clear direction on, you know, how to measure that. The thing that concerns me is that asset allocation and the responsibility that the commission has is a significant driver of the ultimate return of the actual portfolio. And I can understand the value of comparing the asset allocation that we select to, a reference portfolio of a 60/40 or whatever you choose that to be, and determining the value of the diversification. But what I don't see here is our ability to compare our asset allocation construction to our peers. And I know we've had that conversation. To me, it's important. That might not be the benchmark. We may not want our portfolio for a variety of reasons to look exactly like our peers, but we should be able to have the data and the analysis to tell us we chose to look different from our peers, not just from a standard 60/40 portfolio, but we also chose to look different from our peers. Why did we do that? And was it of value to us or not? What price did we pay for that decision? And that's the only way I can see that the commission can be responsible for its decision, is to be able to have that comparison. Because it's not just a diversification, it is the actual amounts of that diversification within each of the asset classes that really drives the difference in the ultimate return.
We don't really choose to be different from our peers though, because we're not making our decision at the same time they're making their decision. We don't know what their decisions were till long after ours have been made and theirs have been made.
That's right. And something that I've asked before, I've asked Jeff and Mike, and I think we don't really have a real good answer for it, is who are our peers? Same size? Well, not necessarily. Funding status? Beneficiaries? And so to take a step back further from what you're saying, that's something that I've been turning over in my head, and I can't figure it out. And, everybody else has said, well, that's a good question.
We've asked ourselves the same question.
So yeah, I'm still trying to get my head around that one.
Well,
And then I see some study that Boney does some kind of peer comparison, but it's kind of not worth the paper it's printed on, isn't it?
Well, to your point, who all's in there? Is it size? Is it funded status? Is it beneficiaries? I mean, so if we're gonna do a peer comparison, let's find somebody that's the same size boat, the same people in it, or same kind of people in it.
Which is us.
Yeah, I mean.
But I think, again, to your point, I think peer comparisons, and we had this discussion too, is what's apples to apples or pears? I mean, the point is what's really comparable. On the other hand, the usefulness of so-called peer comparisons or whatever, to see what other people are doing and why they're doing it, and if we're doing something very different, are we doing something better or are they doing something better? So there is a useful comparison to be made, and it doesn't necessarily have to be made on a apples for apples basis. You know what I'm saying? In other words, we don't have to be completely dependent on the fact that we're comparing ourselves exactly to someone else who looks like us. But I'm more interested very often on what other people are doing and why they're doing it.
I'm in no way discounting the merit of looking at those factors. I'm just saying that.
Let's know if they're an apple or a pear.
Well,
when we do it.
Well, should we be driving the decisions of our apple based on their pear?
Right.
What?
That's my.
But to that, I'm sorry.
No, go ahead.
Well, what I was gonna say is, to me, there's, the way that I look at, the way that I really look at the peer comparison is, I wanna know, I think that, copy and paste is the greatest invention that was ever, because to the extent that somebody's doing something better than we are, we should be looking at that. But I see what the peers are doing as intelligence. right? Rather than necessarily a yardstick, because we have to, I think it's good for us to understand how peers are allocated, what they're doing. But at the end of the day, we have to take that information and put it into our plan to see if it works for us. And I think the thing that, in order to do that, the thing that we have to agree on is what are the risks of identifying the risk of our plan that we're attempting to avoid? And to what degree of probability are we attempting to avoid those risks of our plan? Is it not reaching funded status within a fully funded status within a particular period of time? Is it having to go back to the General Assembly and ask for additional contributions? What are the risks that are important to us? And then we can take, to the extent that we can, to assess what other, the thing that we've seen when Jeff went into a cabin in the woods for like 2 weeks and tore through basically 84 asset allocations of our fellow pair pension fund, or pairs, of all the other pairs out there. And what you see is that there's just vastly different ways that people do things. And they bucket things differently, they call things different things, and within their asset classes or sub-asset classes, you don't necessarily have look through as to what the underlying assets are in those. But, to the extent that you can kind of gain some general themes out of those, I think it's a worthy tool. I just don't necessarily, the thing that I've kind of come back to is, especially in some of the things that we've experienced and the universe data that we've gotten and that kind of thing, it's difficult for me to figure out how you take that intelligence and you fashion it into a yardstick, right? I think it's a worthy and it's a useful, very useful exercise to understand what everybody else is doing. But I think we always got to bring that back to home base and say, how does that work for us? Does it work for us? Is it something that we can do? The most efficient portfolio would be for us to be 100% equities over long periods of time, right? But we can't. It's against the law, right? So, because we're only be 70% equities, right? But that's not gonna work for us. So we got to think of things in the context of what works for our plan. But I think at least when I first got here, I think that there was just a kind of an all-out aversion to kind of looking at what other people do. I think we've taken a tremendous step in that direction of looking at what other plans do, but I think we always got to come back to what works for us. What are the risks that we're concerned about, and how do we use that intelligence in a way that works best for us?
That's why I would say, kind of getting back to something I said earlier, we've got a policy benchmark today. We've made decisions to get there, asset allocation, diversification decisions. But I'd like to reconstruct, if not revalidate that, and that would make, and document all those decisions. Because I think once we set these, let's just focus on the policy benchmark, we've got to continually be challenging that.
I think what you're saying is, could we write it as a procedure so that a future board member could use it effectively, right?
Yeah, but even so we can use it, because a year from now, 2 years from now, 3 years from now, events change, all these economic situations that Dr. Wilder talked about, we may want to re-challenge those same assumptions.
Yeah, but we should have a methodology by
Yes.
which we went about. It goes back to a procedure. It's not just a policy, it's what's your procedure to get to that.
Yes, yeah, and I think peer analysis is one of many factors that we would address in there probably.
Well, I think that, and the important thing is not only how are you gonna do it, but over what time frame are you going to do it? Like, I think what we're encouraging is, as Jeff said, we're hyper focused on the fiscal year to date return, right? That don't mean anything,
Well,
right?
that's where I was going, what I was saying, if he's gonna be bound by that,
Right.
yeah, I suppose his focus is gonna be not on a bigger picture.
Yeah. And so I think we gotta, so lining our focus up with, the kind of the way that I would see it is on an annual basis. you know, we get the new capital market expectations, we can take whatever other intelligence that we want to, and we look back at well, how has this worked over the past 5 years, which lines up to the smoothing period of the plan, you know, or trying to connect those things back. What do we think about as in the future, you know, based on the capital market expectations? And, you know, it's more of a yearly check-in, but we do a major tear down every 5 years or longer. Because, I mean, to a certain extent, you gotta we gotta be comfortable living with the decisions that we make, because otherwise, we're just gonna be chasing something that we're never gonna be able to catch. It's a ghost that you can't catch.
Or worse yet, chasing what just worked.
Yeah, we're gonna chase what just worked, or try to avoid what just hurt us, right? And that's the two worst things that we can do. And those things, you know, decisions need to play out over time, and we need to give ourselves collectively the comfort to allow these things to work out over time, rather than just the constant obsession with the fiscal year to date or last year's returns or whatever. It's meaningful. I understand that, and I'm not discounting the meaning of those, but, you know, we know that we're exposed to markets that are volatile. We know that we're not going to, the one thing that we know is on a yearly basis, we're not gonna earn 7.25%. We know that.
We may.
We may, right? But we're probably not. We're gonna earn a little bit more, we're gonna earn a little bit less. Hopefully over time, that's what we do. You know, so I think we gotta give ourselves the freedom and to evaluate things over a longer period of time, but not, you know, I'm not saying stick our heads in the sand and like pop them up 5 years later, but like the time frame over which we judge decision-making has to be done over a longer period of time, or rolling periods of time.
Can I ask if the bottom half of this slide resonates, you know, kind of ownership of decisions, agreeing on, you know, a timeframe over which it makes sense to measure these? I mean, is this productive way for, you know, Makita and our staff to try to build, you know, and so that we can spend time in commission meeting talking about, you know, specifically, what is the goal? You know, over what period of time does it make sense to measure? You know, is that a productive direction for us to take the conversation? You know, because we're proposing we hold over is it hold over? The AIP.
We're just reaffirming it.
Reaffirming it, while we spend time on these bigger picture issues, but I want to make sure that we're doing that efficiently and spending time in areas that you all think are the right areas to spend time.
Well, not to get bogged down in too many details, but just one thing that just from looking at this page and this page alone, quality of implementation, does it take you 3 years to evaluate that?
Well, you can have a manager that underperforms for 9 months. Do you fire him?
Well,
You know,
no,
it's kind of like, over what period of time do we expect?
I guess, maybe it's a terminology thing, implementation versus execution.
Yeah.
You see what I'm
Yeah,
saying?
I hear it.
I think
I like that better, actually.
yeah. I think what you think about that, you know, obviously you think about that in rolling periods of time, right? Not like we're gonna make a decision and we're not gonna look at it until 3 years from now. But I think the expectation is that you have a longer rolling period of time where you evaluate decisions. And you also, to the extent that you all get more look through into the portfolio and have a better understanding of, you know, individual bets or tilts or whatever that are in the portfolio, we can help you create a better expectation over what period of time you would expect those to play out, right? Rather than, you know, that doesn't mean that every decision is evaluated over that time frame. But I mean, there's gonna be shorter term decisions, there's gonna be longer term decisions, but right now every decision is measured by fiscal year to date.
Yeah.
Right?
And Bill, you asked a question at the last meeting, and I told you this privately, but our staff thought it was one of the best questions that's ever been asked, which was, you know, go back to December. And if we had a simple asset allocation as the baseline, how would that have affected the decision that I made to add equity exposure? I'd like to cast it against the backdrop of if I knew that you would be evaluating me over 5 years for the quality of portfolio destruction, or portfolio structure decisions.
Anybody can do that.
Yeah. I could turn a lot of money into less money. If I knew I had a 5-year time period for the evaluation, I'm much more comfortable making a bigger investment at that time.
Sure.
But the reality is, this is not where we've gone before, so I don't know what that time frame is. I have comfort and confidence with this commission that, you all understand how it works, you would be patient, but I think it would be really helpful to have, if we're gonna judge the implementation benchmark, that's a 5-year rolling time period that we want to see positive contribution from those decisions. That gives me a lot of clarity and an understanding of what are the rules for this. If it's 18 months, I'm not going to make the same decisions. So it does affect behavior.
And so then, to take that a step out further, is what works better for the life of the plan? A decision with a 5-year evaluation time or 18 months, and I think the plan's time horizon is much longer than 18 months, right?
Yeah.
It's
We're operating under that
a little
assumption.
further out, yeah.
So, but, you don't want me making such enormous decisions that the implementation benchmark looks nothing like the policy benchmark. That's the importance of, creating that ecosystem and having the right oversight.
Yeah.
And it's incumbent upon us to spend time on this, I think.
Now, the implementation benchmark, I think you said, would kind of show, when compared to the policy benchmark, would show over, underweight of classes from the policy benchmark, and maybe choosing some different subclasses or something.
Yeah, the composition of that.
Composition, you called it, yeah. So, are we, or as a board, are we gonna set those guidelines? Are there gonna be guidelines that we're gonna set,
Yes.
right?
Yeah, basically what we talked about last meeting was just moving over the existing constraints, just rolling the asset classes together. So fixed, bonds, as an example, would include investment grade, non-investment grade. And I forget what we used as the benchmark for that.
Was it treasury? We talked about using the
Universal index, which has a little bit of emerging market debt, I think, and a little bit of high yield in it. But we would be describing to you all the time, what does that portfolio actually look like? In amount, but also in composition. So that would be one of the ways that we would improve your look-through.
Which now we have you still have the same freedom to look different, but the only thing that you really see is you see whether or not we're in compliance with the ranges, right? But that doesn't give you really an idea of the quality of that.
Right.
Of how the quality of that decision-making. It just lets you know that we're in compliance. Well,
Yeah.
You can be in compliance all day long and run straight into a ditch, so.
You can compliantly lose money.
Yeah, you can compliantly lose money.
I mean, this just goes to, kind of risk budgeting, right? Because essentially he's playing a series of spreads underneath that, right? So, our first risk control is you can have 60% of your money in equities, right? But the difference between international equities and domestic equities is running, 40% over the last 10 years, right? That's a 40% difference on 60% of your portfolio. That's a 24% total portfolio impact being bet on that spread. You can say, no way, that's we're gonna limit that to, so, the next part of the delegation is, okay, understanding what spreads is he playing underneath that, and then putting limitations around those boxes back to the, the compliant report,
Yeah,
right?
we carried over basically, actually, we constrained the portfolio more
Right.
than it is constrained now in what we talked about at the February meeting.
Right.
Because we didn't want the narrative to be, we're trying to, create all kinds of degrees of freedom, unconstrained. No, we actually tightened the constraints on those non-investment grade spread sectors. But
I mean, I'd be happy for what it's worth if we wanted to form a subcommittee, like kind of on delegations, because just other documents, like say for a public mutual fund, when you get into delegations, I mean, they're much more specific, even down to the instruments that are allowed within that delegation. Can you use futures or not, and to what level can you use them or not, and options and leverage, and, kind of back down to what are those parameters, and then how do those roll up, and how's that flow through the board reporting? So for what it's worth, I mean, I'd make myself available. I have a fair bit of experience, kind of what a real, for lack of a better term, a real delegation policy.
yeah, I think for us, it would be kind of one step removed, because it's basically either using the passive menu that Brian talked about earlier, either using passive, commingled vehicles, or our array of approved, managers that we have already in order to implement. So we're not making the instrument decision here in most cases, other than when we use the overlay. But, I mean, I think, to your point, there's certainly a way to tighten it up, and we want to make sure that we're doing this the right way, and the way that the commission has confidence in.
The fact that the commission owns the portfolio allocation decision really hasn't changed from the past, but what has changed is now the commission is being asked to make more consideration of what the alternatives are, rather than just looking at a proposed portfolio and approving it. So it seems to me this means we need to ask more questions about, compared to what kind of questions, and what return could we get from those. And also may need some more reporting, as you have mentioned, about what could we expect from some of those alternatives. And more thinking about alternatives, I guess, is the key to our role in the future, compared to what it was just agreeing to a particular portfolio as presented.
I think it's commendable and correct that we adopt those longer time frames there, and I think those are correct, but I know enough about human nature to know that in practice, we're gonna mentally and emotionally have shorter time frames than those.
You are absolutely correct.
If you set them for longer, at least maybe we move in the right direction, right? Whether you get all the way there or not.
A combined set of 2-year terms now is only 8 years long.
So all in favor of 10?
First, you'll get the first 2 years of somebody else's track record will get judged on your 10 years. Mr. Chairman, I think what we have proposed is, or what we thought is, that we would at least try to, if there's some agreement in regards to the structure, that we would think about the kind of the roadmap of where we would go from here in regards to this. Kind of generally, and this may take longer, I don't think it'll be any shorter than what I'm about to lay out. That, I mean, this, quite frankly, we may get into discussions that take us, and this may take us all of next year all of the, basically a year to do this, to do all of this, but, I think we can at least get you some reporting in this way, probably by September. But what we would propose is that, we have a meeting in June, and that we really take a deep look and provide some alternatives in regards to, the reference portfolio. And if we can come out of the June meeting with having adopted a reference portfolio, I think that would be a good goal. And so in September, I think we would be thinking about looking at trying to get to a point where we could adopt a policy benchmark, which we would submit would be a little bit a simplified, something akin to one of the simplified portfolios that we've shown you. But certainly we can take as many whacks at that as the commission would want us to, and also think about the kind of the underlying constraints that would, inform and ultimately the implementation benchmark, the limits in regards to those bigger asset classes. So thinking about it at the sub-asset class level. And then at the November meeting, aspirationally, we would be looking to have adopt a SIOP and an AIP that incorporate this framework, and I think would make those documents much more usable documents. Now, like I said, this may take longer, I doubt it'll take a shorter period of time, but that is kind of the path that we were thinking about, as we move along through this. And certainly any feedback as to what individual commissioners would want us to see or think about or bring to you in regards to, the reference portfolio and what you would like to see, certainly take direction in that regard, and to Makita as well.
Look, I'd like to see us on the path that you just described, and what I'm about to suggest may require, additional meetings or something, but if we're gonna do it, let's not have it take 6 months to a year. Why can't we get here by Labor Day? I mean, I see the looks on y'all's faces, but if it's a good idea and we haven't agreed that it is, but if it's a good idea, I'm just throwing that out there. I mean, if we're gonna make a change because something's better.
Right. Get on it?
Yes, sir.
I mean, we're here. We're here all the time, so that we're trying to be mindful of your time. So.
I understand that, and I don't want to cause undue burden on this staff either. I mean, sometimes coming up, we have vacation scheduled and all that other kind of good stuff, but if it's better, then why not sooner?
I have no respectful pushback to that.
Our reporting team is very excited by this prospect.
Guys in the back there all passed out.
Just as a show of our beliefs, is there general agreement that this method of going forward is a good one, and that it's worth developing and passing votes on particular aspects of it as they come up? Should we proceed, given what we know now? Any concerns that this is the wrong way to go for future?
What do you say, consultant?
We've had multiple discussions with staff on this. I very much think this is a positive framework to go in the direction of. I think for their sake, in terms of aligning their incentives, but also for your sake, being able to measure and monitor, their success. Yes.
Okay.
I like it. I think we ought to move forward, but I'm still confused. And it's probably just me. I'm still confused about, is this just a reporting methodology, an analysis methodology? Or are we gonna go back and reassess our decisions, risk, et cetera, with diversification and asset allocation? Because if we're doing that, and I think we should do that, if we're doing that, we can do it faster or slower, but it's gonna take a lot of work. And I think it's worthwhile, but I'm confused about which one this is.
Isn't it necessarily gonna be both?
I think it's a little bit, I think
Yeah,
it's both.
I think it has to be both.
It's
but-
both.
I mean, it's both, this is a management tool, is how I would describe it. It's a management tool for me to have. I think it's a management tool for you to have. But it also is a framework for how we go about thinking about asset allocation. We can set it up and wait for that, or we can do that at the same time. So, I mean, it can be, that's gonna be something that's always happening. You know, are we always thinking about asset allocation? I would argue yes.
But that's one of those things we don't, I'm thinking that's why we got 5 to 10 years there. We don't wanna be changing asset allocation
Yeah,
every 2 to 3 months, or even 2 to 3 years if we can help it. Reevaluate, yes, all the
Yeah.
time, consistently,
Yeah, that's what we're
but
saying.
not,
Yeah.
hopefully with the idea of not changing,
Correct.
but reevaluating
Yeah.
constantly, but, okay, I just, maybe I'm just thinking, and maybe it's just because I don't know that much, getting to each decision, okay, we got 65% equities in the reference. Why are we gonna move to 9% private equity? There's a meeting by itself, all the risks and blah, blah, blah. I mean, that's kind of what it seems to me, that's a meeting by itself. And hence, that's why I'm worried about time.
I mean, you are the commission, so you make that decision on asset allocation.
Right.
So,
I like Bill's Labor Day suggestion, first meeting after Labor Day, let's have the heavy lifting done. Is that feasible?
Yeah, I think we
I mean,
probably have to squeeze another, at least one more meeting.
yeah,
in there.
we anticipated the commission wanting more touch points along the way, but, I mean, if we're
Or we might need to
If we're
squeeze
all in the
another.
car,
It's easy for me to
let's
suggest
go.
to the commission, because I live 15 minutes away,
Yeah.
all right?
Well,
For like you and Alan and Ed, you know,
Well, the other thing is too, that we don't, these are, we can have discussions without everybody having, we can have meetings that is just this, where we
Right.
don't do all the other stuff,
Right.
right? You know, where we don't start out with the minutes and the CIO report, the CEO report and all that other stuff. We can have meetings just based on this, and that doesn't necessitate everybody getting in the car and coming to Columbia necessarily.
I assume that was on the CEO's report.
no, I was on the minutes. I would never-
Have y'all already done that first step? It seems like you really don't know the
Yeah, we've
nature of
done a
the
lot of
problem.
work on that.
The reference,
Yeah,
creating the policy benchmark with the same risk factors
Yeah.
as the.
Well, what we've asked
Done that.
ourselves is, can we, assume that we love our asset allocation, what would the reference portfolio be for that? And it's sensitive to, are we talking a global equity benchmark? Are we talking a domestic equity benchmark? Are we talking, there are issues under the hood. If you want us to work with Makita on this as sort of a stand-in for the, kind of weekly or bi-weekly meetings with the commission, we can make a lot of progress real fast and come back and say, here's choice A, choice B, choice C. Get the commission's direction in June, and then keep moving. If we can, if you all want us to move quickly, that's fantastic.
There's no question we want Makita's input. And as much of it as we can get.
Yeah.
Or at least that's, I say we, I do.
Well, let's not go nuts.
thank you, Bill.
Yeah, I'm for you.
There you go. Well, we can provide, I think, why don't we do this? Let's get with Makita, let's develop a let's put some more, a little bit more detail around what we would expect to bring to you in June, okay? Given it's April, so, and we can send that out, a little bit of a detailed plan, okay? We can send that out, and if if individual commissioners want to see other things, they can just let us know. And we can add that to the list, so.
Can we put a timeline on there too?
Yeah, I'll put a timeline, yeah, if I don't hear from you, if I don't hear from you in 2 weeks or a week, I expect that you think it's fantastic, right, so, yeah.
Do we need to give the chairman discretion to appoint committees as necessary between meetings to deal with this, or does he already have that?
I think you can appoint ad hoc committees if he needs to, you know, yeah, if we, you know, kind of get down, if we get to that. And I think, you know, that's probably just as good of a utility function if we just have all of y'all together at one time on either in person or on the phone too. So, you know, we can do those types of things as well, and just not have all the other stuff in it, so, in the meeting. Does that suit? Well, like within 2 weeks or less than that, we'll have a plan of what we would think about. We'll send it out. Is that fair? We'll send it out, and if there's anything else that individual commissioners would want us to include in that assessment, they can let us know. And this would be for the June reference portfolio.
Map of, do a project plan.
Yeah, project plan, yeah, exactly.
So it sounds like we have agreement that this is a good way to proceed, and the beginning of a discussion about how to do it, and the time period to be done in. So that's a start. We're fortunate to have a good staff to do the heavy lifting. So further discussion of this framework. I don't want to cut off discussion.
Is that a slide or no?
Okay, so Mike, you've done the roadmap.
Yes, sir. Yeah, I think that was that. Yeah.
That was that?
Yes, sir.
Okay, good. And so then the next item on the agenda is on the, to continue the annual investment plan. May I have a motion to do so? What's the motion?
Mr. Chairman, just to give you a little bit of color on that, there is a requirement that we adopt an annual investment plan by May 1st. We would like to have an opportunity to incorporate what we're talking about in this portfolio framework into both the SIOP and the AIP. We're in compliance with the SIOP review period, but we do have this May 1st deadline. You all saw Jeff gave a report on the progress of the current initiatives in our current AIP. I mean, obviously, I think we could incorporate this work by reference into that if we would want to, but also there's plenty of ongoing initiatives. So if we just could reaffirm the AIP that we have, there's plenty to keep us occupied until we can get to the point where we can have a new one for a new annual investment plan for you to present to the commission. So the motion would just be to reaffirm the current AIP for the fiscal year 2019, 2020. And, you know, it just occurred to me, we could incorporate this work by reference into that new plan. So that would be the motion.
Questions about the motion? Okay, may I have the motion from a commissioner now?
So moved.
Okay, further discussion? All in favor of continuation of the AIP, say aye. Aye. All opposed, say no. That motion carries then. Commissioners, any further business or comments before the last item of business? Thanks very much for the good discussion today and for the good staff work that went into it. Look forward to the future of using this framework. May I have a motion to adjourn?
So moved. Aye.
Does anyone oppose?
We're over here talking about the framework for what it's.
Okay, so all in favor say aye.
Aye.
All opposed? That does it. Thank you very much.